Welcome to XFO Intelligence Podcast. Today we're exploring a major shift in the family office world, the move from capital preservation to legacy compounding. For decades, the family office model was built on a defensive mindset: protect wealth, minimize risk, and preserve assets across generations. But that model no longer fully reflects how modern family capital, values, and leadership are evolving. The rising generation increasingly sees wealth not as an endpoint, but as a tool for deployment, influence, and measurable impact. The real strategic question today is not whether purpose belongs in wealth management. It is how to build a system where financial returns, verified social outcomes, and intergenerational cohesion can compound at the same time. So what does that system look like? First, next-generation engagement must move from symbolic involvement to real agency. Token participation creates disengagement. The most effective family offices give emerging leaders structured authority, real capital responsibility, and accountability for outcomes. In practice, that often means pilot allocations in the range of $10 to $25 million, where next-gen members help source deals, conduct due diligence, and live with the consequences of actual investment decisions. When active co-sourcing reaches critical mass, participation shifts from obligation to ownership. Competence grows, authority expands, and commitment to the family's long-term vision becomes much deeper. Second, impact investing should be understood as a return multiplier, not a philanthropic side pocket. The outdated idea that purpose and performance must trade off breaks down when impact is treated as part of the core risk and return framework. The strongest portfolios now use a three-part screen. Every opportunity must meet financial thresholds, show credible impact outcomes, and align with family values. That eliminates both weak concessionary projects and profitable investments that violate core principles. In sectors like climate adaptation, financial inclusion, and biotech for underserved conditions, families can capture alpha while also advancing measurable outcomes. In that sense, impact does not dilute returns. It sharpens portfolio quality. Third, governance has to become adaptive. Static constitutions and rigid 5-year plans struggle in a world defined by faster market cycles, technology shifts, and changing generational expectations. Purpose-driven family offices need what we might call a living constitution. Governance sprints held twice a year can recalibrate policies, update decision rights, and remove administrative drag before it becomes institutional friction. Values also need to be stress-tested in practice. Every new investment thesis should be examined against existing commitments and non-negotiable exclusions. Governance, in this model, is no longer a brake. It becomes a routing system for better decisions. Fourth, ecosystem integration matters more than tax incentives alone. Capital may be attracted by favorable policy, but it is retained by trusted networks, repeated learning, and high-quality collaboration. This is where the sticky anchor effect becomes powerful. When family offices participate in peer-validated ecosystems, they reduce discovery costs, improve due diligence through trusted partners, and build both social capital and strategic conviction. Over time, these ecosystems become the real engine for deal flow, talent development, and long-term resilience. Fifth, execution requires a sequenced roadmap. In the first year, families should run values and portfolio alignment audits, deploy pilot capital, establish dual mandate screening criteria, and join curated impact networks. Over the next 1 to 3 years, they can scale proven allocation channels, institutionalize cross-generational learning, and build dashboards that track financial performance, impact outcomes, and family cohesion together. Beyond that, the model evolves toward dynamic allocation bands, redundant decision loops, and ecosystem-level influence. And importantly, success has to be measured. Reduced decision latency, stronger next-gen participation, zero critical values breaches, and better multi-capital compounding are all signals that the system is working. The goal is not simply to preserve wealth in a changing world. It is to build a platform capable of evolving with the world, while staying aligned with the family's deepest purpose. The core takeaway is simple. The future of family wealth management belongs to platforms that treat purpose as architecture, not decoration. When capital is governed adaptively, deployed through validated impact pathways, and led by engaged next-generation decision-makers, the family office becomes more than a wealth vehicle. It becomes a self-optimizing platform for compounding financial capital, social capital, human capital, and intergenerational trust. That is the new legacy imperative. If you found this episode valuable, please like, share, and subscribe to the XFO Intelligence podcast channel. And for feedback, ideas, or collaboration, email us at xfointelligence@gmail.com. Thanks for listening.